Welcome back to Starting Up, an investor's view of investment. Well, that's something all these entrepreneurs are dying to get to know today. Luckily, I got into a discussion with some of India's finest early and late stage investors. Let's go straight to it. The participants in the panel discussion: Mahesh Murthy, partner at the Seed Fund, one of India's most prolific early stage funds; Vivek Joshi, associate director at Kotak Investment Advisors, one of India's foremost private equity funds; Rajesh Soni, president at Reliance Entertainment and an angel investor himself; and finally Anil Joshi, the vice president at the Mumbai Angels. Let's listen in. Hello everyone and welcome to this special panel discussion, the investor's view of investment, and we've got a rockstar lineup of investors here today. So I'm going to start the panel with Mr. Mahesh Murthy. Mahesh, you've been investing in this country for almost a decade now. What do you learn from investing in India? Is it early stage investing, art or science?
I think it's an art because what we do is we're not sitting here doing a lot of complex Excel calculations and valuations. I think the value that we think we provide or that needs to be provided at the early stage is to really help students and others figure out how to start a company, how to build a successful business. And that's really about relationships, about mentoring, about partnership, about shouting at each other. And a lot of that is more art than science.
Okay, so you're saying people skills plays a large role more than Excel skills?
Yeah, at this point, I mean, even at later stages, I don't know if they'll agree or not. I mean, an Excel spreadsheet typically should be categorized under a work of fiction.
Anil, just to toss this over to you, once in 2 months you'll have these wonderful events at the Mumbai Angels where you line up 8 startups and you guys sit there and listen to these guys pitch. So what are you all really looking for when they pitch?
Mahesh has rightly said, it's more an art. I think we look more on a team, whether that team can deliver that $1 billion idea or not. Whether that team has a capability to turn around the situation and have all hits while they are working on this one idea and can make it happen.
Okay, so it's a good time to bring in Vivek. Vivek, you look at companies at a late stage, right? So how different are the criteria you look at as opposed to an early stage person? Is it more of a science for you?
Yeah, it does become a little more of a science, but first of all, the focus on the team, the promoter and his management doesn't go. Plus, the other big difference is that there is a track record of the firm and the promoter which you can look at, followed by how well they have formulated their strategy in the past, how well they have been able to execute strategies, what kind of business plans they have in place, what kind of formulated their strategy in the past, how well they have been able to execute strategies, what kind of business plans they have in place, what kind of ambitions they have in place.
Rajesh, you've been an entrepreneur. You've built companies under a corporate umbrella. You've also invested in early stage guys. I want to put a question to you. When, in your view, should a company really look at investment?
You see, I think for me it's very important since I'm just talking about angel in early stage. The person needs to put his skin in the game, right? So what do I mean by that? It means you just don't have a business plan. You have actually probably exited the company, or you have put some resources to develop the product, or you have gone to your friends and families and borrowed some money, right? That's the skin in the game. Once you have that, and that shows the conviction of the entrepreneur behind his own product or service, that's the time to go to an angel, right? And raise some angel money. You should not, and I say it again and again, when you just have a business plan or a vision or half-baked product, especially in India, you cannot go to the venture firms.
Can I add something to Rajesh's point? I think it's very important for people to understand. Many of us have entrepreneurs as heroes. You may have Narayan Murthy as a hero, or Dhirubhai Ambani, or Richard Branson, or Jeff Bezos, or Bill Gates, or Steve Jobs. These guys may be your heroes. Look behind every one of them. Not a single one of them took venture capital to start. Right? I really must say that the first and best way to start a business is not to take funding from anybody. The second best way is to take it from angels. The third best way is to take it from institutions like venture capital funds and such. You look at the Fortune 500, I'd be very surprised if more than 20 companies out of the top 500 ever venture funded.
So I'm actually going to move the panel to to a much debated point, and it's something that hopefully all you guys are interested in. So Mahesh, an entrepreneur comes and makes a pitch to you, and you've invested in microbreweries, in .com companies, and across the domain. So how do you actually go about valuing the company?
At our stage, basically, the first thing we try to tell our entrepreneurs is don't worry about valuation. Just think about one or two things. Remember that I am simply going to be a midwife and guide in a company. 4 or 5 years from now, I won't be here. The company is going to be back with you. The second thing is to understand that I'm not interested in majority stake. I understand from history that if I take a majority stake, you get disincentivized. So our typical stakes would be somewhere between 20 and 40%, and maybe around 30, 35, 33% on an average. The third stage is how much money do you need to comfortably break even. So, there's a very simple way of doing that. On a spreadsheet, you draw columns as your months. You have the rows as your expenses and the rows as your income in the months that those income comes in. Then you have one row which says what is your surplus or your deficit of your income over your expenses, and the row below that says what is the sigma of that, what is the cumulative surplus or deficit. You draw that curve. At one point that sigma will go this way, in the sense you hit rock bottom and slowly your deficit goes down. That is your peak funding need. So roughly we kind of do that and add some more and say, okay, fine, we believe that your peak funding need maybe 5 crores, maybe 10 crores, maybe 18 crores, maybe 20 crores. And typically based on your peak funding need and based on those kinds of 20 to 40% number, it may end up as whatever it is. Your valuation is then decided saying, it seems that you need about 8 crores and we'd like to get 30% of your company. Oh, by the way, that means the valuation is 25 crores.
But Mahesh, that means companies which need more capital by default get valued higher.
Yeah, but then it has to prove that it needs more capital, and when it needs more capital, it needs more people. Those people will get stock options. It's not that you're going to get richer in any way.
So Rajesh, I wanted to ask you a question. So one question everybody has here is do I have better chance of raising capital if I go after a market which is a big market, or should I concentrate on my own business? So how important is the sector for raising capital? How much you look at the sector?
I don't, I'm a tiny little guy, but most of the market, and I can tell you from my experience, is herdish in nature. So for example, today e-commerce is in fashion.
Group shopping.
Everyone is talking about social shopping, group shopping, Groupon is the flavor of the month. Last year it was education, a year before it was VAS, next year God knows what. I remember I seen this cycle 3 years back. It was every venture firm needed to have a restaurant chain in its portfolio. They told me, if I don't have it, my LP will curse me. Why don't you have this restaurant chain? Everyone has got it. So I think they're today in the same mindset. Why don't you have an e-commerce thing? So here is the way I see it. You do your thing. Don't worry about which sectors are in favor.
Mahesh, does it make sense for an entrepreneur to look at trends and capitalize on those trends?
Absolutely not. So we certainly don't invest to trend. We in fact, if somebody comes and says, Gartner says, that immediately there's 3 minus 5 marks put there. IDG says another minus 10 marks. If you come and quote consulting companies to us, some of us who worked in consulting companies know that it's all.
So we're nearing the end of this fantastic panel. Just to finish, closing comments from all the panelists. I'll start with Rajesh. Rajesh, the one thing that delights you the most when an entrepreneur makes a pitch to you?
Sense of humor. No, I mean it, lightness of being, in the sense that it's a tough journey. Entrepreneurialism, having said that, is a tougher choice that a person makes. So I look at whether that person has that ability to do the journey.
Okay, great. Mahesh?
I'd love to see complete passion and commitment and a mad, insane desire to solve a problem.
I look 2 things. One, how honest entrepreneur is, and how flexible he is. I think these are the 2 more meaningful parameters for me.
There are 2 legs, so 2 things: ambition and attention to detail.
Great. It's been a fantastic panel. Thank you very much, panelists. Thank you everyone for watching. Some very valuable insights there. Hope you folks have taken notes. While I sip my coffee and check out the wildlife here behind me, it's time to take a quick break on the show. But coming up, 3 startups, 2 days and a business plan. What comes out of it? It's iWeekend right after this break.